So I'll go ahead and start. Like I said, before we jump in who we are, kind of why we're all here. We're here at Worldwide Denver. There's a lot going on in this market, and we're seeing a lot of money coming in from different countries, different states, and so we find as the experts, it's our responsibility to educate the community, and that's why we're here. So hopefully you guys take something away from this, and you guys at home as well. But Worldwide Denver, that's our way to kind of give back and be the expert.
And promote a little bit about Denver to the world. Western Investor Network started around 12 years or so. I've been around about 30. I guess I should have mentioned that. I started in real estate in 1986. Bought my first property in 1986. Was licensed in 1990. Did mostly investing for 20 years, and then the last recession was kind of tough on me. So going through that, I met a few brokers. Decided I wanted to do a little broker, so I opened up the firm and just came up with some really pretty good ideas. And it's kind of taking off and paying off now to where we can, we're doing a lot of business and doing a lot back. So I'm happy to do that. Western Investor Network is a commercial brokerage, really full service, acquisition, disposition, tenant rep, landlord rep. We do hard money lending, we do commercial property management. Really anything you walk in the door with, commercial real estate wise, we want to be able to help you or be able to send you to somebody if we don't do it in-house, which we can easily do. So that's us in a nutshell.
All right, and the fun disclaimer. So real quickly, we're not attorneys, we're not accountants, and we're not going to be acting as any of those. We are professional real estate agents, and so we're going to stick to what we know. So with everything we're going to talk about today, we advise you guys to definitely consult with your attorneys, your accountants, and your financial advisors.
Definitely. Very good. So I'll extrapolate a little bit on how this presentation is built. So the focus right now is on the Denver market and the craziness that's happening. I think we're all seeing it, and it's something we want to talk about. The idea of this was to spread some of the things that we're seeing around to the world. So as we frame the conversation with the growth in Denver, I think we want to talk about how people can get involved who aren't already. So we've got Investment 101, some basics, which some of you are going to know, might be news to some of you. And then from there, we're going to dive into the nitty-gritty, which will be the differences between the residential and the commercial side of things, and just how we like to do it. So
I tie all together with some pros and cons.
Yeah, absolutely.
There you go. So with that, let's get started.
All right, so I like this little clicker we got here. So Denver, it's an international marketplace now. With all the money, like I mentioned briefly before, coming in through international and institutional money, the prices in Denver are definitely being driven up. And so big reason is the growth. A lot of people are moving here. Big reason why. This is me right here before I fell. And we're all trying to do backflips. We have world-class sports, 4 seasons of the year. A lot of people come for the fact that there's a good chance that whatever you're into, recreational, we have it. So,
And sports teams. So we got the 4 major sports teams. We got a couple ancillary teams. So anything sports-wise, any city that has the 4 major sports teams gets a look from some of your institutional investors. So Denver's come a long way, and
And so we have sports teams. You have obviously 4 seasons. You also have the fact that this was the birthplace for recreational marijuana. The second state, as you know, to legalize medical marijuana behind California, but we are the first state to legalize recreational. Now there are 30 states and the District of Columbia who currently have laws broadly legalizing marijuana in some form, and there are only 8 states, including the District of Columbia, that are legalizing recreational marijuana. Therefore, we are a pioneer of that industry. Colorado is, Denver. And so a lot of knowledge Denver has is being spread out to these other states, and so we're also getting a lot of attention because of that.
And a lot of this is bringing major development.
So the Gaylord Rockies project, largest project in the country right now. That is a hotel convention center project out in Aurora by DIA. National Western Stock Show is the largest stock show in the world, $856 million upgrade. Denver International Airport, 18th busiest in the world, and the 6th busiest airport in the United States with a $3 billion upgrade process. The I-70 project, I call it the CAP project, revitalization of I-70, $1.2 billion. So we've got some pretty large construction projects going on in Denver right now.
Most of this is funded by the city as well. I think it's a great point. The city wants to grow.
Hence the light rail and transportation station as well, but not the
Major out-of-state investment. Cherry Creek North Apartments. So these are just some deals that have been done here by large institutional investors from outside of Denver. So the Cherry Creek North Apartments, record-setting price, $141 million deal. Miami firms buying the Denver Tech Center for $32 million. Singapore and the Colorado Office Park, $117 million. And that Google's Boulder office build out there, $131 million. And that's just a small list of the things that are going on. Denver has a whole lot, Denver and the metro area have a whole lot more projects. That's just a few that we ran through.
And if we didn't talk about Denver being hot enough, this is going to go ahead and kind of be the icing on the cake here, but you have cap rates that if this chart was extended over here and a little further back before 2013, you're looking at cap rates around 10%. Right now, 2017, 2018, it's less than 5%. Now this is a graph illustrating the cap rate for every purchase in the Denver metro area, all commercial real estate purchases, not this one specialty. So it's just telling the story of what the institutional money and out-of-state money is doing to this market. It's making it more expensive.
Good time to get into the basics of investing.
So how much energy do you want to dedicate to your investment? How much time do you have to dedicate to your investment? A couple of key points that you want to go into first. You decide where you want to be, commercial or residential investing.
And not only trying to figure out where you want to be in terms of where you want to invest or how you want to invest, but understanding what the risk tolerance is. The perception for a lot of people is that residential real estate is less risky, right? Yeah, the dollar amounts might be less, but what we're going to kind of talk about today is the difference maybe between some of that perception and some of that reality based on how you're underwriting things and kind of where you process it. So,
knowing your return requirement will help you decide what type of investment to make. So you're going to want to decide, do I want a 7% return? I'm okay with 9. Do I want more of a 15% return? Where you want to have that, where you want to fall. That's going to help you decide what product type you're going to invest in. Knowing how to measure your return is where you need to start. So that's where you either need to get some advice there or dial that in on your own.
Here's some advice.
Residential.
yeah, there you go. You got your pens. I'll grab them right now. I'll let you take this.
Investment. All right. Residential investment analysis. Typically, you got 3 types of analytic processes. There are gross rent multiplier, cash-on-cash return, and a cap rate. So gross rent multiplier, where you take the value of the property divided by the gross rent, pretty much what it says. That would get you a number that would tell you how long that would take to pay off that property at that rate of return, not factoring in any expenses, capital expenses, or anything else. Cash-on-cash return is the return that would be figured on your actual investments, your down payment plus your closing costs. That would be a number, and that would be shown as a percentage when you divide that out. And a capitalization rate, go back to cash-on-cash rate, that would factor in your debt service. Cap rate does not factor in the debt service. So that's on the net operating income divided by your purchase price will give you a percentage as well of what your yield is on that property at the time.
Now, before we move on, we are going to go into an example of this later on at the end. But if anyone has a quick question about these,
Is anybody using these now?
using these or not using these, an opinion?
What do you find an investor looks the most carefully at? I mean, to me, a cap rate is kind of a quick sketchbook position of the property. Is it the cash-on-cash return that is the most attractive to most investors that you guys deal with?
I'm going to start, I'm going to let him finish. I think I'm glad you said that. Nick's a commercial real estate agent. Right here, we're talking about residential. The way you just described cap rate is kind of how I describe gross rent multiplier. The gross rent multiplier is not taking in any expenses. It's a very scratch on the napkin type valuation, in my opinion. So I know a lot of my investors are going to look at all three of them. Well, what have you seen, Tony?
Yeah, same thing. I think with residential, you see a lot of cash on cash, and more commercial is going to be your cap rate. And sometimes we'll use a combination of these three and maybe a couple other things that they like to use. These are your three most common on the residential side. I think cash on cash would probably be the most common, just because it's fairly easy. Gross rent multiplier is really easy, so therefore I don't believe it has as much, people have as much faith or trust in it.
Right.
And going to this next slide here, these are, I'm going to let Tony extrapolate on these, but you have your three, your IRR is another a big player in that as well. When it comes to
So
commercial.
cap rate, we already went over, that's pretty much based on your NOI. Gives you a yield for the investment as you're purchasing it. The IRR, internal rate of return, anybody utilize that? I knew you might. Or you can find that. I'll give you the CCIM definition. So the internal rate of return is your return on every dollar in the investment for the period of time that it's in it. So cap rate would be good for, say, a less than 12-month or 12-month return. IRR, if you're going to get into a 3, 5, 10-year investment, that's when you're going to be looking at an IRR, more of a blended type of return.
There's also something called an XIRR, which accounts for when you take money out of the investment. IRR is return on every dollar, as Tony said, while it's in the investment. If you take money out of the investment, then there's another calculation called XIR that can account for you taking money out. So often I use XIRR and IRR.
And then the potential for development. So in commercial property, you're going to have potential for future redevelopment, rezoning, and maybe some profit potential there that you maybe wouldn't have in residential. Residential is typically platted lots, you got homes already built, and there's not much, you're not going to be able to change the zoning there. It is what it is, it's residential zoning. Commercial, the area might catch up to you. Take a look at Brighton Boulevard right now, great example. Drove down there the other day, everything is being reconstructed on there for about a mile down that road. If you had bought in there 20 years ago, that's the potential that you can have with commercial. You're not going to see that type of redevelopment or that type of rezoning in a residential neighborhood.
I think you should explain the difference in cap rates in comparison to property types. Obviously, a long-term lease with IBM would generate a lower cap rate than an office warehouse, that's not leased.
Cap rates are
right?
all perception of the investor. So if I were going to be looking at an office building and I'm okay with a 6 cap, then I would buy it at a 6 cap. But there are, I think maybe what you're asking are the differences between the product categories.
Yeah, like an office building that's leased for 40 years versus one that's leased for 1 year would have a different cap rate, right? To a lot of investors.
Right, it's going to be the investor's opinion of what they want to invest in that.
Right.
What
But
return
a
they want.
40-year lease on an office building with the federal government is pretty secure versus a 1-year lease with a startup company.
Yeah. And kind of what you're talking
Right,
about.
so the investor would pay more for that as they would than the startup can. So
Yeah,
they're just-
exactly.
it's their decision.
And therefore the cap rate would be probably
Yeah, right. And so a big reason why, without getting too much in the weeds there, we agree with you. I agree with you 100%. At that point, you're looking at the value of the lease, almost a little more than you're looking at how we're
And
evaluating
I
the
think
value
that's
of the property.
important to point out is that a lot of residential realtors that I talk to, they have no idea that, how a commercial property is valued, and it's valued on the lease.
Big part of it, absolutely, yeah. And if we had more than an hour,
It's
believe
going to
me,
be a big part of that. So triple net would be the same. Like in this market, triple nets are in the 5, 6 cap range. Some of them are selling, if you break it down to a price per square foot, $500, $600 per square foot. You can't build that. I mean, you could build 2 or 3 of those, right? For that price.
yeah.
But-
Go ahead.
Sorry.
Oh, go ahead.
I notice a lot of commercial brokers in town lately are putting pro forma numbers in their marketing material.
You don't do that, do you?
No, and I'll tell you why I don't, because I don't quite understand the concept of it's not what I did with it, it's what you can do with it type mentality in the marketplace. How do you guys address that at all, or do you just leave it out of it, or how?
I guess it depends on which side of the deal we're on. So, you know, as a listing broker, yeah, we might put a pro forma together. I have a listing on a property that I own right now in Colorado Springs. I have a vacancy of one building. It's got 3 buildings on it, a vacancy of 1. And I put a pro forma on that, what I thought was a fair market value for that, so I can show, you know, what that could perform at.
Okay. So I guess it would depend on the product type and how much vacancy, rather than totally scraping it and coming up with another number that may or may not be achievable. Which, quite frankly, I see some flyers.
And I think you're hitting on a pretty important point. Is
Definitely.
how
It's getting out
well.
of hand.
Yeah, a lot of these. You know, and I'm hesitating because I don't want to go too far and down this rabbit hole. But you have a lot of brokers that are putting that performer out there because they think that may help them. In my opinion, I'm not sure that's really helping anybody except for having a lot of long conversations that are never going to amount to anything, right? And so, but we're in a tough market right now, and so people are trying to sell their properties. And so people are trying to sell properties for what they could be rather than what they are, especially in cannabis. And some of the other niche markets that you're not able to get the federal funding from or federal financing. And so that is something I deal with every day. It drives me insane as well. So yeah, I do not know if I have an answer to that.
Yeah, now on my side, you want to look at that deal and you want to strip the pro forma out of it and buy it, or advise your buyer to purchase that property, how they're going to have to operate it right now, not how it's going to operate 3 years from now, because you're going to have a lot of costs to get to that pro forma income stream.
Yeah, great question.
Hey guys, getting back to cap rate, is the textbook definition of capitalization rate, is that supposed to include debt service, or is it just that commercial brokers
Good
pretty
question.
much?
I thought there was an answer to that. No, cap rate does not incorporate debt service. Cash on cash return does.
Yeah, okay, gotcha. So it's assuming you're purchasing a property for cash,
Correct.
Correct.
which
Yep.
is hardly ever the case, or seldom the case.
Right.
Yeah,
We
but
always-
it's an easier way to compare the number of properties.
Yeah.
So you pay cash for 5, you're evaluating 5 properties, break it all down to I'm paying cash for all 5, and you can narrow it down to your 3 and 2 and get to
Okay,
one lot.
okay.
It's a good way to calculate your initial yield as well. So. All right, so details of investing. So what we're going to go into here on a lot of this is a lot of detail, but we're going to start kind of talk about residential versus commercial. You have single-family homes, condos, townhomes, a duplex, a triplex, or a quadplex. In terms of a lender, a lot of people have different ideas of this, but in terms of a lending standpoint, up to 4 doors is still considered residential. When you get to 5 doors or more, you're now considered commercial. And so with the commercial products, you have apartment buildings, office properties, retail properties, industrial flex properties, specialty properties, the list goes on. These are some of the most common that we see.
All right, and let's talk residential.
See some of the benefits.
Typically a less complicated transaction, so residential or, their homes, you don't have the lease issues and environmental due diligence and some other things we'll talk about. It's a less complicated transaction.
Yeah.
Smaller deals, less money.
Probably not consulting with as many accountants, attorneys, things like that. Typically lower property values, so it's easier for newer investors. As I kind of mentioned before, perception, reality, 2 different things, but the perception being that, you do have lower property values, you're dealing with a lower amount of money, and so the deals could be a little easier for somebody who's new or somebody who's just not willing to lose that much money.
So historically, residential, single-family homes that had a little bit higher return. Analysis that we're going to show you a little bit later that I did, that's kind of changed. Property values for residential are way high. They've had like 10 years of consistent growth. Not necessarily record profits every year, but growth, 10% growth or so a year, so they're really up in value. So it's hard for rent to keep up with those values.
And so what I'm gonna do here too, is I'm gonna talk about a couple of these because I wanna make sure we get to the end. I know we're running a little low on time. But looking at, I think where we left off here is longer term financing at typically lower interest rates, as well as typically less sophisticated sellers, kind of combining those two. With the lower financing at typically a lower interest rate could go along with the fact that you're working with lower cost properties. And then kind of switching down here to less complex, expensive due diligence. Tony touched on this earlier. If you're dealing with a residential property, you're most likely not going to need an environmental. You may only need an ILC versus a full ALTA survey. And so with residential, you probably all you need is an inspection, appraisal, and then, like I said, an ILC versus a full ALTA survey, which is going to save a lot of money. So yeah, I want to wrap these up.
Typically, you're easier to lease the vacancies, so you have one home, you don't have a lot of the TI and other stuff that you have in commercial, which is tenant improvements, lease clauses, attorneys bouncing things back and forth. Exit strategy to an owner is an owner. You got two really, owner occupants, so someone that's going to buy the house to live in it, or someone that's going to buy it as an investor. So you got a couple of exit strategies on the end. Residential tax rates, much lower. You'll see these in the evaluations if you're not familiar with both already. It's taxed at a different rate, and it's much lower than commercial. Commercial is the brunt of the county's income, and personal and emotional transactions. So residential is personal, and therefore it's emotional. You can send the kids to school, live there. It's an emotional thing as compared to commercial, which I guess we can move on to the next slide. That is more of it's a business and financial decision. So you're going to go buy a property for your business, your storefront. It's either going to fit what you need and be able to fit within your budget, or you're going to move on and look for something else.
And as an investor, this is a great segue into the commercial investing. It's nice to know that your tenants have pride of ownership. They're running their business out of there, so they're going to treat your building pretty well, I would imagine, right? And so I'll go ahead. So go ahead and start us off here, Tony. I think this is
So yeah, larger amounts of money, to get in. Commercial properties are larger than a home, so it makes sense that they be more expensive. You need more down payment. Matt touched on the tenants. They're going to have their care of the property because they're running their business out of there. Business directed professional transaction. I think we dealt on that. You're going to make a decision based on financing. Dealing with knowledgeable sellers and agents. So in a commercial transaction, you're going to have an accountant and attorney typically involved in it, as opposed to buying your home. Typically, that's not the case. You have a real estate agent who advises you and closes that deal with you. Longer term tenants with multi-year leases, so they're 3, 5, 7, 10, 15 triple net deals we talked about earlier. It could be 20 or 25-year leases.
I'll give you a break here. So then we have these last four here. These two I think go together. Let's start here. Typically longer term tenants with multi-year leases. You're looking at 3 to 5 years minimum most of the time typically. As well as you can build in these rent escalation clauses. So from day one when you're signing a lease for a 5-year tenant, you know the type of increases in rents that you're going to be getting based on the market. You also have tenants who may be willing to share some of the cost of tenant improvements, which is bringing value to your building down the road as well. And then the chance of future profit from rezoning, redevelopment. Tony kind of touched on that earlier, so I'll move right by that. And then the less regulatory oversight on commercial real estate, commercial leases. Now, I know it says this here, but what I talked about earlier, a little bit of perception, right? Not a lot of people know that the federal fair housing laws also apply to commercial real estate owners who have businesses who have businesses as tenants, just like residential. So if you guys remember anything, it might be one thing you guys remember, because not a lot of people know.
Most people don't know that. Colorado legislature has made federal fair housing law apply to commercial sales and leasing in Colorado. Differences in financing, so general residential and general commercial. So residential, you're 20 to 30% down, you're a little bit higher, a little bit lower than maybe a commercial interest rate. Terms are much longer, that's your amortization term is much longer, and the term typically matches that, as opposed to commercial, where you're going to be maybe 0.5% or 1% higher. Your amortization is going to be shorter, 20 or 25 years, and then the terms are going to be what's called ballooned at 3, 5, 7, 10 years. So they're going to have a call on your note, might have a 20-year amortization, but it will be due in a shorter period of time.
and right into a residential analysis.
So this is where we can slow down. This is the good stuff for you guys here. So, yeah, there you go.
Much. So this is just one that, I guess they're passing those out, so I'll just keep going. $300,000, this is in the MLS, currently is an active listing. So you do a pretty normal, 80% loan to value, 20% down, closing costs in there. So 60,000 down, 69.6 would be your total investment. So you're going to use that for what? When you go to base your cash on cash, you get down here to your report for cash flow before tax. That's what you use to do your cash on cash. So $1,900 a month, it looks like a fair rent for that. About $600 per bedroom. We can add a little bit because it's just such a hot market. Taxes, insurance, repairs, and maintenance. Some evaluations that you see from a broker won't involve or won't include the repair and maintenance. I always put something in there because you're always going to have a repair on the property. I don't care what it is. Net operating income, that's where we derive that. So that will be used for your capitalization rate.
So yeah, so real fast before we move on, just to kind of, does everyone kind of follow this so far? I know we're passing out.
Trying to go it fast because
Yeah, no worries. I think we're
definitely jump in if you have some questions.
Yeah, I think we're going right on time. Let us know if we're too far. But the big thing we've been talking about a lot is NOI. So I just want to point that out real quick. Everything he's kind of mentioned up to this point, if you're moving down the chart, is to get us here to this NOI. And so right now with the NOI at 19,625. Go ahead, Ty. I don't want to cut it off.
No, that's all right. Lost my figures. Everybody understand that so far we got down to?
All right, great.
Okay, cool. Loan amount, that's your debt service. So then that comes off that, and that's the number along with that one we use for your cash on cash. So that's how we came up with 5.9%. This into that. Capitalization rate, 6.55, that's your NOI to your purchase price, gross rent multiplier, that's your purchase price to your gross rent. And that's how we came up with that. So 13 years to pay it off if you don't have any expenses, 6.55% on capitalization rate, and about 6% on your cash on cash return. So in my mind, that's not real good. When I was investing in houses years ago, I was in the 12 to 15% range. So would I buy this deal? Not personally, but you know, it might be somebody looking for a lower return, more secure, might look at this.
Right. And that's one thing just to notice before we go to the next slide is the three ways to analyze this is you have your cash on cash, your capitalization rate, as well as your gross rent multiplier. So we're looking at all three.
Type the three together that we talked about earlier.
Any questions at all? There's going to be a quiz. That was real quick. Everybody, really? Any questions? This is a conversation. Everybody good?
You want to know about the commercial stuff, huh? That's what we're all here for.
All right. On to the good stuff.
All right, so this is called annual property operating data for an APOD. Anybody seen one of these before?
On every flyer, right?
All right.
Yeah.
It's not as messy as it looks, really. This is property that actually I own.
It's the second sheet too in your hands, brother.
So let's say purchase price is 1.9, expenses 22.8 and 15.2 for your loan fees. That's basically a percent on that. 418,000 is your initial investment. Here's your loan numbers. So that $1.52 million loan be $8,800 per month, periodic payment over 12 months, and you get that's a 5% interest rate. That's how you put out and calculate that. Expenses, potential rental income, this is $13 per square foot on a 17,560 square foot building. Gross rent. 5% vacancy factor. You go to a bank for a loan, they're going to take the 5% vacancy factor, whether you're full or whether you're 10%, they're going to take 10, but they're going to use 5 as their minimum. Okay? Gets us down to ERI, or effective rental, of 216. There's no other income with this building, so if it was an apartment building, you had laundry and soda machines and stuff, you could add some additional income here. This is a commercial property, or excuse me, an office warehouse property that does not have that. Taxes, insurance, off-site management, repairs and maintenance, utilities, so you got exterior lighting, water and sewer, gas and electric, accounting and legal, miscellaneous, supplies, it's kind of a miscellaneous column. Your exterior, you've got the grounds, so that's the big pick, repairs, lot striping and stuff, trash removal. It's a contract as is snow removal, which is actually kind of low. We've been pretty dry the last couple of days. It's good for me, bad for the snow removal. Total operating expenses $79.5. That gets us to an NOI of 137. And again, we base our capitalization rate off of that, divided into 1.9 to 7.23 cap rate.
It's a little higher than the 4 or 5% cap rates we saw historically going on right here.
And then you figure your debt service into it, that gets you down to your cash flow before taxes of 31,262. And so then you divide that into your 418, gets you your 7.48. And then the gross rent multiplier would be 1.9 divided into the rent, 8.32. So eight years to pay it off, not factoring in any of this. 7.23% yield first year, and cash on cash return is 7.48. I know I went through that kind of quick. Questions, Kurt?
Now, are you going to have an AM of 25 and a term of 25 on that building? Are they going to make it? Are you going to make the term 5 ballooned at 5?
Yeah, I plugged, that's not the loan that I have on, I just plugged a new one. For this evaluation, the term doesn't matter, it's more what you're
Yeah, I get you.
into that right now. And if you get into figuring an IRR, and maybe you got a 3-year and then you got a 5, then you're going to have to put those numbers into that.
So we're kind of talking about risk. I mean, that's what I factor into risk would be, okay, when am I going to have to refinance this? And this market going to go well in 5 years or whatever. So I get what you're doing here. You're trying to get to cap rate.
Yeah, and that's it.
Yeah, just get down to the current
But if I'm coming
valuation.
from the residential side, that's the trepidation there, right?
Right? No, exactly. And I think that's a big reason why IRR and XIRR are used so commonly in commercial, where we obviously ran with these 3 right here without the debt service. Tough to run that IRR, but yeah, you're exactly right. That the more ways you can evaluate a property, probably the less you are at risk.
The more variables, right?
Yeah, exactly.
Yeah. Or you're going to know about it.
So knowing how to do all of them is important. You can't just do one. You're increasing your chances to lose at that point, I think. So, Nick?
I know that vacancy collection at 5% is standard to plug into these formulas, but I get some pushback on offsite management if there isn't a manager from the sellers of the property. How do you handle that? Do you always include that, or do you only include that if it's actually there?
I guess how I explain it to them is they want people to look at it and purchase it at a fair price. They want to, you're going to have to factor in management.
What if it's a
Investors-
two-tenant
Investors
industrial
aren't going to
building?
manage it themselves. Most investors aren't going to manage it themselves.
But would you use a
That's
product
always a
type
hard
like
conversation.
industrial, say a two-tenant industrial building where having an off-site property manager is kind of a, I mean,
It eats up a lot of income, I understand.
yeah, because I have a problem with that with my sellers. They're managing their own properties, and they're like, well, there is no management fee, and that's really cutting into the cap rate and all these other formulas by plugging in. And I understand the DNC at 5%, but do you kind of take that on a case-by-case basis depending on the property type and how many tenants? Or do you always throw it in?
Triple net, it's easy to get it out of there, right? Because there is no management there. Well, if it's an absolute net, there's no management or no owner responsibilities. How do you handle it? What do you say to them?
I do it on real time. But if they have a manager, it's plugged in. If they don't, I won't. Because I don't want
So
to.
at that point, you're leaving it up to the market and the buyer to come in and make an evaluation on that. And then they will run their numbers, hopefully, on how they're going to operate it. And that would be how they base their offer.
And one conversation I've had in the past is, well, if we're going to go forward with this and that's your problem is paying a management company, I know that I've had certain conversations, as long as the numbers work, obviously, there's things that we can do as a firm or other firms might have a property management arm that they might be able to blend that in as well, and they kind of take that off the plate because it helps them gain more business for the property management side of the company as well. So that could potentially be an option, hence why I think I decided to work with Tony and the Western group of companies is we do have that hard money arm. We have the partnership with Horizon Capital. We have the property management side as well, so that we can kind of play with those numbers a little bit to make it more advantageous. But I think the correct thing to do is to do it in real time, as you do. Correct.
Dilip, did you have a question?
Yeah, in this one, I didn't see the results. You're not taking that into consideration?
Results.
Reserves, typically factor reserves in there, so that's a comment you could add. If you want to put, what he's asking about is reserves for capital expenditures, or CapEx, which would be roof replacement and large expenditures on commercial property. Yeah, I just chose not to put that in there on this evaluation.
Do you include that in your expenses and it affects NOI, or do you do it outside of NOI?
I would do it outside of the NOI. Is that how you evaluate yours, Lee? Outside the NOI?
Yeah, I mean, I don't do that.
That's what I should-
NOI, that's outside. It's like, almost like a servicing the loan.
There you go. Yeah.
So if you got here's a good question for you. You got $100,000 in reserve and you sell the property, you pass that on to the new owner, or you keep it.
Well, those buying, you sell it.
So if you like the buyer, you're going to give it to him? Yeah, typically those don't transfer.
I have one more,
Awesome.
and that's about next month.
All right. There we go.
We're going to be talking about syndications and our Return Accelerator. I'll let you guys get the plug.
Right, so syndications, hopefully you're all familiar with that, but it's really, in a nutshell, just bringing a group of people together to invest in a property, like-minded investors. So Nick and Dilip might not want to invest, you might retail, might be industrial, that might not be a good fit, but a group of like-minded investors together to invest. And the Return Accelerator. You want to run that this time?
Yeah. So the Return Accelerator, I will keep it very high level. And feel free to reach out to us afterwards if you have any more questions on the Return Accelerator. A lot of it might sound familiar, but what we've done is attack this thing in a way that works for us and our investors. And so dealing with a lot of 1031 clients per se, for example, you go into a purchase and you own the property and you're leveraged at above 50%. So let's say you own it free and clear, just for sake of conversation. You own the property free and clear, and you know, since we helped put you in that property, hence maybe it was 1031 money, you wanted to make sure you got it closed, so you were debt adverse, right? So you own a property for $2 million, and you now have the ability, because it's cash flowing, you have full tenants, tenants are at 100%, you can borrow, say, up to 75%, maybe 50% of that money. So now you have access to $100 million on a line that you can write hard money loans on, maybe increase your return to about 15 to 18% based on what you're charging for a hard money loan. You can purchase a non-performing note if you're looking for maybe more risky of an investment at a 20 to 30% return. If you talk to us, we would have a long conversation with you about how we do not feel like that is more risky of an investment. And so looking at different ways to boost your returns, hence the Return Accelerator, by utilizing the equity that you have in a current property and getting a little more creative on the side without really increasing your risk. And that's when it comes, that's when we come in and kind of underwrite these things. You know, we have a lot of people sourcing them, and so that's where we know that the things that we're capable of doing are very unique to us, and that's what we are willing to help and really educate you guys on how to do. But at the end of the day, it's, you know, you're going in and you're utilizing your equity.
Yeah, it's a great program. So I want to clarify something that he said earlier with the $100 million.
Yeah, $1 million.
It's a Return Accelerator.
I'll tell you what, man, where's your contract? Because I'm signing on right now.
That's why he lets me go. He lets me go, he cleans it up. Yeah.
So, yeah, it's a $1 million property, pull $1 million out, you invested in hard money loans. So you got an 8% return on that building, right? Cap, normal market rate return of 8%. Okay, we're pulling out $1 million at 5%. So it costs you $5 to go to the bank and borrow that. If you're an ex-banker, it's interesting to you. So you got 8% on $1 million and 3% on the $1 million that you pulled out. So you're still getting a return on it, but we have that $1 million we can invest. So we take that simply into a hard money loan. Pretty easy to place it, 12% and 3 points. That's a 15% return. So we took we took that 8%, took 5 off of it, so it's 3, put 15 on top of it. So your blended rate on that return, I don't know exactly what that is off the top of my head, goes way up. So that's the idea of Return Accelerator. we can take your equity and really accelerate it, as it states, to a much higher level, and you can keep your core asset. So you have your strip center. This building, I'm not building, I don't think I want to sell it, but I want to tap the equity and get some higher returns. Now, what I forgot to mention in the last one when I talked about this briefly was, if you're a little more risky, and we'll get into talking about Prologic here in a minute, and it's perceived to have a little more risk, as Matt had mentioned, but a non-performing note. So I've done some non-performing notes where we're hitting 20, 30%. So instead of that 15, you pull that out and you hit a 30% return on that, or 40. That's a game changer. I mean, you're making some good money on your equity, and you're still holding your core asset. So that's the idea of Return Accelerator. Syndication is next month. Stan Wood from Prologic Capital is going to be joining us to speak on that. So I appreciate that. And I had another thought that totally just escaped me. But any questions on that? I know I went through Return Accelerator pretty quickly, but that's an interesting concept. It's an awesome concept, actually.
Your presentation is very professional. Some I understand, some I don't. How do you work with a client that says, I have both property and I have cash? I'm not quite sure what I should be doing. He walks in the door and talks to one of you or three of you. What fee schedule is he looking at for your expertise?
Well, first we would sit in council with him and find out what he actually wants to do or needs to do. Not necessarily wants, it probably is the wrong word. A lot of people think they know what they want to do, but it's not necessarily what they need to do. So we would sit down with them and counsel them. And so to get into the program, that's a very good question. So syndication, we would just work for the co-op commission on that, and then there would be a fee involved in managing that as it goes forward.
Okay, and just real fast, I do have a lot of conversation with people like that, where I literally, the last listing that I have, it's an owner of a strip center that wanted me to do landlord representation. And he also had another side deal over here where he was coming into about $2 million worth of equity, and he was looking at investing that in a different place in commercial real estate. He didn't want to put it in a hard asset. And so after our conversation, I introduced him to Tony, we sit down, and now we're, like Tony said, counseling with him and solving the bigger problem. Whether he has a problem or not, we're bringing him different solutions, and so it's all about counseling and really asking the right questions.
And speaking of questions, I think we can go ahead and take any more outside of this room, because it's 6 o'clock and we have to vacate. So this is a profoundly interesting program that we have, and we'll be speaking about it next month. So let's
Also, Candace is going to be handing you a sheet to fill out. If you would please fill that out and return it to us. We appreciate it. It's going to ask about location and what you thought and some other things. So please get that back to us.
Yeah, take your time.
Ask questions before we're moving out.
Make us look at this thing. Maybe, we do want to get invited back, so we'll get that here quickly, but yeah.
But thank you everyone for coming.
Yeah, appreciate your time.